Well, good afternoon, ladies and gentlemen, and thank you for joining our Q1 webinar. For those that don't know my name, it's Gabriel Carey. I'm a co-founder and director of Merkle Capital. I'm proud to have been involved with Merkle Capital as we've now built a strong reputation for offering institutional grade, actively managed crypto investment solutions with a strong focus on risk management, governance, and investor protection. As I'm sure you're aware, Q1's brought significant turmoil in broader investment markets, but as Dean will cover in the presentation, the fund continues to perform really well. In fact, it was up 16% in April, and we're currently up 15% month to date. Before we do kick off, just a general disclaimer. Important that you know this is general information only. If you are interested in investing, please seek personal advice from a qualified advisor. We're fortunate to have Dean and Ryan with us today. Dean, CEO, Ryan McMillan is our Chief Investment Officer. As CEO, Dean has led the firm from inception right up until today when we're one of the best performing funds across Australia. In fact, in FY24, we were the top performing fund across all asset classes. That's directly attributable to Dean's background in building and scaling technology startups, having combined that with his hands-on experience in digital asset operations. That's been invaluable to the firm. And his expertise are used to ensure that we're selecting the right assets, and also we have operational excellence internally to support the fund's success. Ryan has more of a traditional funds background. He brings that traditional finance knowledge into the portfolio management. He's responsible for shaping the fund's investment strategy, overseeing the fund's risk management framework, and leading the portfolio execution. Ryan ensures the fund delivers institutional grade portfolio management with a disciplined approach to both risk performance in all market conditions. So today's presentation is broken into two parts. You'll hear from Dean, and he's going to give you an update on the performance and also might discuss a little bit of the secret sauce in the fund. And then we'll hand over to Ryan to deliver a market outlook. And he's going to highlight some of the factors that are likely to drive returns in the coming year. Presentation should take around 25 minutes, leaving ample time for you to ask questions. You can also post your questions throughout the presentation. So as I mentioned at the start, just click on Q&A at the top of your screen and you should be able to ask questions throughout. Without further ado, I'd like to hand over to Dean to kick things off.
Thanks, Gabe, and thank you to everyone who's joined the call. I know we've got a mix of current investors and curious and potential allocators on the call today. So what I might kick off with is a bit of an overview of our fund and how we think about the markets and how we allocate to the markets. So just to get started, it's really important to highlight that we are a 100% liquid token fund. So what that means is we don't invest in early stage VC deals, equity deals or locked up tokens which may have vesting schedules or anything like that. We focus solely on the liquid side of the asset class and also predominantly in the top 50 assets by market cap. And this is a very deliberate strategy. By focusing on the bigger liquid tokens, we're looking at projects that are more established, more proven, and also have greater liquidity. So, they're trading on the large exchanges, there's lots of trading volume and we can move in and out of those assets freely. And on top of that, so we're an actively managed fund. So what does that mean? Our job at both the IC level and internally is to make sure that we're looking at what's happening on the macro landscape. What are the tailwinds? What are the headwinds? What do we think the risk setting, if you like, for the fund should be at any point in time by looking at the macro? And then we dive down into the crypto aspect and we think about, well, which are the projects that we really think we should be invested in through different phases of the macro and the crypto cycles. And then once we've invested in those assets and we own them, we take the custody aspect very seriously. So when we first launched the fund around 4 years ago, we launched using Coinbase Custody, with Coinbase Custody as our institutional custodian of our assets. And we selected them after doing some really deep due diligence on a range of different options, and they also provide us with insurance over our assets through Lloyd's of London. So we take great comfort in the safety of our assets. Some of the assets in our portfolio allow us to generate a risk-free yield via something that's native to crypto called staking. So some of those assets that we stake while they're in custody generate those yields, and when blended across our portfolio, we see somewhere in the vicinity of 3 to 4% of yield per annum, and which covers management fees of the fund plus more. In terms of thematics, what are the thematics that we focus on when we think about investing into crypto? In the most basic sense, it's the picks and shovels. So we like the blockchain infrastructure. We like decentralized finance. We like decentralized physical infrastructure. We stay at that picks and shovels level. We don't go chasing the new shiny toys that pop up quite regularly in the space. We stay at the infrastructure layer, and that's because we think from a risk and an investment lens, we think the asymmetry is there, and it's the right lens for us in our portfolio. So if we start looking at performance, okay, so as Gabe mentioned earlier, we've been fortunate enough to be recognised by the AFR both for FY 23-24 as the best performing fund in Australia, and then last year we were the third best performing fund in Australia. And if we have a look at more recent performance, this is for April, we got 16.5%, which is a great month. As we were talking about, we had a really challenging, I think, since the 20th of January and Trump took office, we saw obviously the tariff wars kick off, and February and March were challenging months for both crypto and the broader markets. And we really do think that strength is starting to return to the markets. Ryan will deep dive into that a little bit more shortly. However, we do feel like things are on the bounce quite strongly at the moment. If we look at this chart on the bottom right here, which is looking at the Merkle Capital digital asset fund performance over the last couple of years against both Ethereum, which is the leading smart contract platform in the space, so the second largest crypto project after Bitcoin, and also the Eureka Crypto Hedge Fund Index, which is a basket of crypto-focused hedge funds globally. We can see over the last couple of years, Merkle has performed very strongly against those two. And just going to, on the next slide, just have a little bit of a look into how we've selected assets that have allowed us to get these results, and just talk about that a little bit more in terms of the context of our portfolio and asset selection. So we're gonna look at layer one adoption, and so layer one is essentially the underlying blockchain tokens, and so the blockchains themselves, which included projects like Solana, Ethereum, Near, Sui, these type of projects. What we do is we are mid to long term investors. We're not looking for short term buying opportunities, and we're not swing trading. So we're looking at buying the assets that we believe are going to be the leaders in 5 to 10 years time. And we do that by looking at the data and where the growth is happening. So we're looking at sort of where the puck's going rather than where it is right now. And what's fantastic about blockchain technology is we can look at on-chain data to determine this. And so just this slide here, I just want to demonstrate a couple of examples of what we're looking at to help us inform asset allocation decision making. So this first one here is daily active addresses, and we're looking at comparing most of the leaders in the space on-chain data from an active address lens. You can see Solana is performing exceptionally strongly at the top there in green. And what's interesting here is it's growing and it's outperforming some of the other leaders in the space. And if we're looking at value-based investing, Solana's market cap is around 1/3 or 1/4 of Ethereum's. Yet on all the key metrics that we look at is significantly outperforming and growing at a greater rate. So we think that the value lies there, and hence Solana is a cornerstone of our portfolio and has been for a few years now. Another really interesting metric is the revenue that's generated by Solana and the ecosystem projects in the Solana ecosystem, comparing that to the other ecosystems. And this was, I think, a snapshot of a week last week where there was over $50 million of revenue generated across all major blockchains. Solana accounted for just under 52% of all of that revenue. So its revenue dominance, if you like, was 52% across all other blockchains, which is a pretty astounding metric. But this is, again, looking at on-chain data real-time on-chain data. We're not relying on third-party analysts to provide reports to us. This is using tooling to give us a look at exactly what's happening on-chain and make decisions around that data. I might hand back to Gabe.
Thanks very much, Dean. Now we'll hand over to Ryan to give us an outlook on the markets.
Thanks, Gabe. Yeah, so I think to really have a look at the last quarter, which was pretty rough for all markets, it's better to zoom out and have a look at a couple of quarters back for perspective. Here we're looking at Bitcoin alone, but that's a really good directional proxy for the rest of the crypto market. Post-US election, there was a really euphoric pump, welcoming a Bitcoin and crypto-friendly administration into the White House. That sort of ended mid-December when the Fed walked back some rate cuts that they had planned for 2025 in their guidance. So they put a bit of cold water on all markets. We tracked sideways for a little bit until Trump's inauguration, and then it didn't take long for the tariff tensions to start rising. So it was a really tough market for that 2.5 months after that, until the 90-day pause was announced. We saw Bitcoin was down around 30% over that time. A lot of alts were down 60%, but equally NASDAQ was down around 25% over that period. Since early April, that 90-day pause was announced. The market's rallied pretty strongly since then, and we'll be able to recover a lot of that lost ground in Q1. And that's the wider story, and we do expect that to continue. If we jump on to the next slide. So that was a bit about Bitcoin. So what are we looking at for alts? Alts are effectively everything that is not Bitcoin. In this chart, we're actually looking at others, which includes all altcoins outside the top 10. And what this is showing us is we're really looking for an alt season rally here, and you can see that there's 2 previous cycle ones here. So the chart shows alts represented by those coins outside the top 10 divided by Bitcoin. So it shows the relative performance against Bitcoin. We've highlighted those 2 huge periods of outperformance that happened in 2017 and 2021. And believe the conditions are right for a third alt season this year. That not only aligns with the 4-year crypto cycle, but also the global liquidity environment. Timing this mega trend is core to what we do. It's ensuring we capture as much of this upside as possible. And also just remember, these figures are outperformance of Bitcoin. So in a period where typically Bitcoin is also rising, the absolute gains have been really significant here. We jump on to the next slide. So this chart has done the rounds a little bit on Twitter and a few different crypto podcasts, but we think it's really telling, and thought we'd include it as well. It shows global M2, that is global cash and bank account balances, which is an easy to track global liquidity measure. And this has been expanding for several months, as you can see by the yellow line. Versus Bitcoin in orange, which is closely tracked global liquidity metrics. There's been a really strong correlation, particularly over the last 2 years with this particular metric, but even more pronounced when there's a lag of 80 to 90 days on the Bitcoin price. That is, that Bitcoin has followed global M2 with an 80 to 90 day lag. So here we can see M2 has ripped higher earlier this year and continues to move higher. We think there's a pretty high probability that Bitcoin follows this to new all-time highs in the coming months. So we can see global liquidity is going up there. We expect a new wave of central bank hikes to continue. That's already happening around the world. And the Fed is one of the last ones, or the main one. We want to see follow that trend, with inflation figures coming in pretty soft last night. We think that opens the door to some more rate cuts later this year from the Fed, and being the biggest one of the biggest M2 components of that chart, then when they start to add, which they haven't really been adding to a lot, this is a lot of the other participants adding to that impulse higher. When the US starts to add to that as well, that'll be really, really interesting. So the last couple of months, we've seen a pretty good recovery from that Q1. And interestingly, it's really been institutional-driven rally. So metrics like Google Trends haven't picked up, telling us that retail probably isn't the main driver here. And so are the size, as you can see, in on-chain data suggesting those smaller purchases of Bitcoin aren't the ones driving this latest couple of months move higher. But what has been driving it is corporates. So this trend of corporates adding Bitcoin as a treasury asset to their balance sheet has really taken off in the last, this year. About 200 companies are now buying Bitcoin to hold on their balance sheet. And Michael Saylor expects this to increase to about 700 companies next year. He also announced a plan for MicroStrategy to double their Bitcoin purchase plan from 42 billion to 84 billion. So there's some pretty serious moves happening in that treasury, corporate treasury market. And interestingly, we've also seen a handful of companies adding Solana as a treasury asset to their balance sheets as well. And we expect that to continue. A Solana ETF is expected to launch later this year. Polymarket has an odds of close to 90% probability on that, and this will open the door to more institutional investors to more easily access assets like Solana via an ETF. While ETF flows have been a little underwhelming, they still have attracted 2.5 billion in flows. If we get anywhere near that coming into Sol as a much smaller asset, there'll be a huge move up in price on that as well. In terms of risk factors, regulatory risk really has faded since the Trump election. So what has actually happened, which is a bit more interesting, is US states are now passing Bitcoin bills and laws as well. So New Hampshire recently passed a law to allow them to invest 5% of their assets into Bitcoin, and we expect others to follow, Arizona and Texas next up. So there's a real change in the buying of Bitcoin. It won't be as retail driven this cycle. There'll be much more institutional adoption and even sovereign adoption as well, looking really, really likely. So keep an eye on that. And in terms of trade tensions, it looks like they are starting to calm down. We've seen the basis for a template, I should say, for what deals might look like after UK and US announced a trade deal. And obviously there's been communications with China to give a 90-day rest in escalation there. So there really is a lot of upside in where the macro is looking at the moment. It looks like the worst of those risks are behind us, and equally a few of those global conflicts are looking to calm down as well. So the rest of this quarter and the next rest of the year are looking really positive for the market.
Thanks very much, Ryan. So to wrap it up, I think it's fair to say the clock's ticking. We're pretty excited internally. As you heard from Dean, we managed a 16% return last month. I think the important point to highlight there is there was a 6% outperformance against Bitcoin. And that sort of flows into the comments that Ryan made. So the macro tailwinds, they're here. The regulatory environment has probably never been any freer than what it is at the moment. You've got a very conducive government to the crypto space. And that creates a real asymmetry that we believe will play out over the next year. This alt season can be incredible for the space. It doesn't come around often. In fact, once every 4 years, we believe we're on the precipice of that. So, it's a really good opportunity for the fund to outperform because we're positioned to take advantage of that alt season when it unravels. So opportunities like this don't come around so often. If you would like to take the opportunity to invest, please do so by logging onto the website. If you're just after some more depth in terms of any specific items we've covered today, please reach out to Dean, Ryan, or I. We're happy to answer any questions. But before we do that, we'd like to open the floor for questions from you. I did get one emailed in, Ryan, that was just around the 90-day pause. How do you see that impacting the space?
In terms of the China pause?
US, yeah.
Yeah, I think From my view, it looks like we might have the template for what Trump would be satisfied with tariffs, and that might be 10% on everybody and more like 30% on China for now. And if that's the case, the market's welcomed that. So you know, I don't see a re-escalation. I think we might have a really good template for how we navigate out of that Q1 turmoil.
And then one for you, Dean, just on Solana. So you went through the on-chain metrics, and it's quite incredible to think that 50% of the revenue is coming through into Solana. When do you think that'll be reflected in price?
I think it's starting to happen now. We've seen some huge moves recently off the back of this. I think we in-house, we do believe that when QE, we think quantitative tightening is starting to wind down, and when QE kicks in, we think this cycle may be a bit different. And the reason being is that we have literally hundreds of thousands of projects now. So we think liquidity will flow into the projects that have the actual fundamentals to support them. We think the institutional money coming in will be smarter, and it will be looking at metrics, adoption metrics and growth metrics to work out where they allocate. So we think in coming months, I think Solana could really make some very, very strong moves. And as Rhino just mentioned before, if we see that ETF get green lit in the States, and it could actually be the first ETF that includes staking as well, which the Ethereum one doesn't. I think we might see some serious institutional money flowing to Solana. So I think in the short term, we think it's gonna be a strong performer, and over the course of the year, I think we see some huge upside. I think it's trading at around $180 today. I think its all-time highs close to 300. So it still has a long way to go. We think there could be multiples in Solana over the course of this year.
Thanks very much, Dean. Now I've let everyone's mic. You will need to unmute yourself if you'd like to ask a question, but you can do that now. So we take any questions from the floor.
I can see one in the Q&A box here, Gabe, which was how are we positioning the portfolio in anticipation of a potential alt season? And are there any particular narratives, and if so, why? I think Dean sort of touched on that. We were not adding risk at the start of the year. In early April, we did start to add a little bit of risk to the portfolio. We've got good exposure to alts, but particularly at the blockchain level. So there is room to go a little bit further out. And if we see the start of that alt season, getting more confirmation of that happening, we will look to move a little further into some of those things. We already hold some, but it'll be increasing some allocations there. And if there are any particular narratives, I think it really is the general maturation of the market, in that more institutional investors in the space will be doing more due diligence. So we probably, no, I don't expect to see an alt season like we have the last couple, which are just everything goes up. It'll be much narrower breadth, and we probably see a few things that don't have a lot of utility won't run as hard, and those that are with real adoption will be the real winners. So it's not necessarily what narratives are going to run, whether it's AI or gaming or things like that. I think it'll be whoever's getting the adoption will be the ones that will be the winners.
And then one for you, Dean. I know you like to put a number there. I've got a question. What do you expect the growth in terms of percent of the fund will be over the next 6 to 12 months? I'll just start with reflecting back on that M2. So the graph that Ryan showed you of money supply and the price of Bitcoin, it is uncanny just how accurately, or the correlation of those two, how accurately it tracks. And if you go back to a week ago, before this de-escalation in the China-US tensions, Bitcoin was already rallying. So if you have a look at where it's going now, it's driving up. It is absolutely following that M2, and it's lagging by 81 days. So if you follow that graph up, there's significant upside on Bitcoin in the very short term, let alone the long term. But over to you on the percentage growth over the next 6 to 12 months.
I love this question. Not financial advice. I think, and we were calling this even last year in November when the markets were very strong before the Q1 pullback. I think Bitcoin can get to somewhere between 200 and 250K over the next 12 months. And so if we see Bitcoin doing a rough 2x in that time frame, I think our portfolio overall can do significantly more with our alts, anywhere between 3 and 5x over a similar time frame. We hope to have some that are even more explosive in a couple of the smaller holdings that we hold. But when blended across the portfolio, we're hoping something in that vicinity. And this is all on the back of we really do want to see that QE and M2 uptick continue and even accelerate, which we do think is coming over the next 6 to 12 months. And a lot of that capital flowing into the smaller end of the market, the alts, is where we really do see that explosive period. And our role, I guess, on the back of that, as to add a little bit more as asset managers, here is to capture that upside and roll it back into the portfolio, into the safer assets, whether that be by buying more Bitcoin or by moving it into stable coins to crystallize those gains. That's the window we'll be looking for over the next 12 months.
We've got 2 final questions. One is, why does it make sense to invest in a crypto fund like MTC rather than investing directly? I'll do a preamble and then hand over to both of you. So I think the first thing is fees. One of the things that people like ETS for is they're a low-cost way of getting exposure. If you look at our management fees on this slide, it's 2%. The yield on the fund is around 4%. So what that means is it's got a negative carry. So in fact, relative to an ETF, you're paying negative 2%. And an ETF might be 0.5. So in fact, you're 2.5% just in MER better. I don't think that's necessarily the reason. What I think you really want to do it for is because you've got professionals that are looking at this every day, day in, day out. They live, breathe, and act on the knowledge they've got from the last 10 years, hands-on experience, traditional finance, all culminating in the one group with a very logical process to select protocols that will perform, which really drives the performance. So the active management, I think, should not be understated, and the process that we adopt to select the assets is very, very important. Comments, gents? I'll go with you first, Ryan.
Yeah, I would just add that to this sector particularly, active management can really outperform. So there are real information discrepancies in the market. Some markets are super efficient, like US equities, and it's really hard for active managers to outperform an index there. In this market, we think there's scope to significantly outperform those indexes.
And anything to add there, Dan?
No, I think that's it. That covers it well.
The other question we had here was, do you have your eyes on any new allocations into projects that aren't currently in the portfolio? So we might talk about the bench, what we're looking at adding, and if there's anything that we're on the precipice of adding. Ryan?
Yeah, so we've just done a report on 00. So this is a new protocol that is looking to effectively speed up the blockchain infrastructure, being the internet, and dedicate some physical infrastructure, cable that is, just for blockchain. So that's a project we're quite interested in. It hasn't gone on sale yet, but it is raising capital, and it's something from that bricks, that picks and shovels approach that we really like. So we'll be keeping an eye on that and better understanding the tokenomics when more information is published on that.
Please do keep the questions coming. We will answer those that we don't answer today via email, so you will get a response. But I'll take this one from Russell. To what extent did the fund's asset allocation change over Q1 as alts tanked and BTC paused? Want to answer that one, Dean, or leave it with Ryan?
Sure, yeah. Look over the so we're looking at mid to long term investment allocations. So for example, in February we had a really challenging month. Bitcoin was down and alts were down more. We weren't looking for short term trades in that aspect. We still believed we were in an overall bull market, and that this was a short-term, volatile period, if you like. So what happened there was our Bitcoin holding did increase relative to other assets in the portfolio, just purely due to market movements. But we we didn't go risk off through that period. We stayed allocated, and we maintained our position, and we're obviously in a good spot now to capture that going forward.
Right. Thanks, gents. Look, if we didn't answer your questions today, we will get an email to you. Thank you very much for your time. As I mentioned, please reach out to Dean, Ryan, or I if you do have other questions. Absolute open door policy, or jump on the website if you'd like to know more.
Thanks, guys.
Enjoy the rest of your day.
Thanks for joining, everyone.
Thank you.